The Bank of England Governor Andrew Bailey spoke recently with Bloomberg's Francine Lacqua. They talked about the big upgrade that they had for the UK economy, plus the bank's asset purchase program.
We've been clear today, we have not changed the stock of quantitative easing that we're doing this year. So what we've changed is the pace at which we achieve that stock. But actually we haven't changed the end date. We always said we would end it around the end of this year. We front-loaded it somewhat because back in November we were in the midst of an upsurge in COVID. We were concerned about, financial markets situation, the performance, and ensuring that financial markets continued to be robustly performing. So it made sense in terms of market efficiency to front-load it. We've now got to a point where we think it makes sense to now move back to a flow that meets that eventual target.
And you've made that very clear. Given how the markets initially reacted, what does it tell us about market positioning or market exuberance, or how much focus will be on any signal on tapering?
Well, I fully expected, I can tell you, I fully expected we'd be having discussions like this because, it's reasonable for markets to ask the question. And of course, there is this point about bringing out the difference between open-ended and fixed QE programs. They are different in that sense.
So, what are your expectations for QE next year?
I don't have any expectations at the moment at all. I mean, because the decision we took today was to say that the current policy setting was appropriate.
But what kind of trend are you expecting? If you look at your forecasts, right, they're built on 2 rate hikes over the next 3 years, and that has inflation just at target.
Yeah.
Is your next move tightening?
Well, we don't, of course, our forecasts don't validate the markets in that sense. We use the market profile to construct a forecast, which is then, used in the policy process. What I would say is that it's quite interesting when we also publish a constant rate forecast conditioned on constant rates, i.e. the current setting of policy. I mean, the difference in inflation terms at the terminal point of the forecast between the market path and the constant path is pretty small, in fact, in inflation terms. So I wouldn't overinterpret the point about the market curve, but just to re-emphasize, it's a convenience for us to use the market curve, and I think it's helpful, but it does not determine policy in the sense that it's not mechanical.
How do you manage market expectation? Is that something that you worry about given where we are?
Well, obviously we do think quite hard about, how policy will be interpreted in that sense. We watch very carefully how markets do respond to it. But at the end of the day, as I say, it's one input to our policy-making process. It's by no means the only one. And just to re-emphasize, we're not validating the market curve at this point.
Can you give us an indication of how you tighten? So is it rates first or QE?
Well, we're doing the review at the moment, or we will be doing the review. We started it. And the reason for that is that the MPC adopted guidance back in early 2018 on this point and said that they would tighten, or they would increase rates up to a level, I think it's 1.5%, before they considered reducing the stock of assets. Now, what I would say is that, of course, state the obvious, an awful lot has happened in the intervening period. So the stock of Bank of England quantitative easing has risen substantially, obviously, as a product of COVID. It seems, therefore, appropriate to come back to that question and say, does what's changed in the meantime, cause us to adjust our view?